A lot of people hear Kevin Warsh talk about inflation and immediately assume he must be bullish for the US dollar. The logic sounds simple. If the Fed chair is hawkish, interest rates stay high, capital flows into America, and the dollar goes up. That is the popular view right now. And it is not irrational, because Warsh has been trying very hard to sound serious about inflation. He does not want to look like a political appointee who walks into the Federal Reserve and starts cutting rates because the White House wants cheaper money. He wants credibility. He wants markets to believe that the Fed still has a backbone. He wants the bond market to believe that the central bank is not going to surrender every time the economy slows. But the more interesting question is not whether Warsh sounds hawkish. The more interesting question is which inflation number he actually believes. That is where the whole story changes. Warsh did not rewrite the official inflation thermometer. The Fed still has a 2% inflation goal measured by PCE inflation. The Bureau of Economic Analysis still publishes PCE. The Bureau of Labor Statistics still publishes CPI. Nobody woke up one morning and found out Kevin Warsh had personally changed how the United States calculates inflation. That is not the argument. The argument is more subtle, and because it is more subtle, it is also more important. Warsh has been shifting the preferred lens for judging underlying inflation away from the traditional headline numbers and toward trimmed mean or median-style measures, which remove the most extreme price movements on both sides before estimating the trend. That may sound like a technical debate, the kind of thing only economists argue about in papers nobody reads, but for financial markets it matters enormously. A central bank does not cut interest rates because inflation exists. It cuts interest rates when it believes inflation is no longer the main danger. So the real battle is not only about inflation itself, it is about the story the Fed tells itself about inflation. If the Fed looks at headline inflation and sees prices still rising too quickly, it has a reason to keep rates high. If the Fed looks at core inflation and sees services inflation still sticky, it has a reason to stay restrictive. But if the Fed looks at trimmed inflation and sees that the underlying trend is much closer to target, suddenly the policy conclusion can become very different. Warsh can say he is not ignoring inflation. He can say he is looking through temporary distortions. He can say energy shocks, tariffs, geopolitical disruptions, and one-off price jumps should not automatically force the Fed into over-tightening the economy. He can sound responsible while preparing the intellectual ground for rate cuts. That is why I think the market may be reading him too literally. The market hears the tone. The more interesting signal is the model. When a central banker changes the lens, he changes the conclusion that becomes acceptable. Imagine two doctors looking at the same patient. One doctor only looks at the fever and says the patient is still sick. Another doctor looks at the blood work, the trend, the source of the fever, and says the patient is recovering even though the temperature is still elevated. The treatment will be different. Inflation works the same way. If Warsh believes the visible inflation number is being distorted by temporary shocks, then he can justify easier policy before the old framework would have allowed it. This is why the dollar story is more bearish than people think. A currency is not only a reflection of nominal interest rates. It is a reflection of real returns, credibility, fiscal discipline, capital flows, and relative trust. If the Fed cuts rates while inflation is still above the official target, even if it has a sophisticated explanation for doing so, the real return on holding dollars can fall. If investors believe the Fed is becoming more willing to tolerate inflation, the dollar's credibility premium can shrink. If the US government is still running large deficits and needs to keep selling enormous amounts of debt, then lower real yields become a problem. Foreign investors do not fund America out of charity. They fund America because they believe the return is worth the risk. This is where the Warsh inflation lens connects to the long-term dollar depreciation thesis. The United States already has a fiscal problem. The government spends more than it collects. And that gap is not small. The deficit is not behaving like an emergency measure that disappears when the economy recovers. It has become structural. Interest costs are rising. Debt service is eating more of the budget. The Treasury has to keep borrowing. And the world has to keep absorbing that borrowing. At the same time, the United States runs a current account deficit, which means it consumes and invests more than it saves domestically, and relies on foreign capital to fill the gap. This is manageable when the dollar is trusted, when U.S. assets offer attractive real returns, and when America looks like the cleanest shirt in the global laundry basket. It becomes more fragile when the Fed starts cutting, before inflation has clearly returned to target. The dollar does not need to collapse for this thesis to work. In fact, collapse is the wrong word. The US dollar is still the main reserve currency. It is still the currency of global trade, global debt, global safety, and global panic. When there is a crisis, money still runs into dollars because the alternatives are not deep enough, liquid enough, or trusted enough. The euro has political problems. The yen has debt and demographic problems. The renminbi has capital control problems. Gold does not pay interest. Bitcoin is still too volatile for central banks to treat as a serious reserve anchor. So this is not a childish death of the dollar argument. The better argument is gradual depreciation pressure. The dollar can remain dominant and still lose purchasing power. It can stay central to the system while becoming less attractive at the margin. Reserve managers do not need to dump dollars tomorrow for the dollar to weaken over time. They only need to diversify slowly. Private investors do not need to abandon America. They only need to demand more compensation. Foreign governments do not need to rebel against the dollar system. They only need to hold a slightly lower share of reserves in dollars each year. That is how a reserve currency weakens in the real world. Not usually through one dramatic headline, but through 1,000 quiet allocation decisions. Warsh's preferred inflation lens can accelerate that process because it gives the Fed a language for tolerance. The Fed can say inflation is still above target, but underlying inflation is improving. It can say policy is still restrictive, but less restriction is now appropriate. It can say it remains committed to price stability while lowering rates. Technically, all of that can be true. The problem is that markets do not only care about technical truth, they care about incentives. If the United States has a large debt burden, a large fiscal deficit, and a political system that wants easier money, then every methodological shift will be judged through that lens. This is why investors should pay attention when a central banker starts talking about better ways to measure inflation. Measurement is never neutral in policy. What you measure determines what you can justify. If you measure inflation in a way that highlights broad, persistent price pressure, the Fed has to stay tight. If you measure inflation in a way that trims out the biggest shocks and focuses on the middle of the distribution, the Fed can argue that the economy is closer to price stability than the public feels. That gap between measured inflation and lived inflation is politically dangerous, but it is also market relevant. Most people experience inflation through the things they buy most often. Food, fuel, rent, insurance, utilities, and basic services shape the public mood. A trimmed measure may tell policymakers that extreme price movements should be ignored because they distort the signal. A household may hear that and think, that extreme price movement is my grocery bill. Both views can be valid, but they lead to different politics. If Warsh cuts rates while ordinary people still feel inflation pressure, then the Fed may preserve its economic argument but weaken public trust. For a currency, trust is not decoration. Trust is the product. The counter-argument is strong enough that it deserves respect. If Warsh is genuinely hawkish, if he keeps rates high, if he refuses to cut until every major inflation measure is clearly moving toward 2%, then the dollar can remain well supported. If U.S. growth stays stronger than Europe, Japan, and China, global capital can keep flowing into American assets. If AI creates a real productivity boom, then America may deserve a valuation premium, and the dollar may not weaken much at all. A productivity boom can offset easier monetary policy because it raises real growth and improves the return on U.S. capital. That is the serious bullish dollar case. But that bullish case depends on a lot going right at the same time. It depends on productivity growth being real, rather than mostly a stock market story. It depends on fiscal deficits not scaring the bond market. It depends on inflation expectations staying anchored, even if the Fed cuts with inflation still above target. It depends on foreign investors continuing to accept U.S. debt at yields the U.S. government can afford. It depends on the world having no better alternative to the dollar, which may be true, but no better alternative is not the same thing as no depreciation risk. The bearish dollar case is less dramatic, but more durable. It says the United States is moving into a world where fiscal policy wants easier money, monetary policy has a framework that can justify easier money, and foreign creditors are being asked to fund a country whose debt burden keeps rising. That combination usually does not produce a stronger currency over the long run. It produces pressure on real yields, pressure on credibility, and pressure on the exchange rate. This is why the Warsh story matters beyond the Fed meeting headlines. Everyone wants to know whether the next move is a hike or a cut. That is useful for traders. But it is not the deeper issue. The deeper issue is whether the Fed is preparing a framework that allows it to call inflation less dangerous than the headline numbers suggest. If that framework becomes dominant, the Fed can cut without admitting surrender. It can cut while claiming discipline. It can cut while saying the true signal is already close to target. That is exactly the kind of policy shift that can hurt the dollar slowly. There is a difference between a weak currency and a currency that is being deliberately managed lower in real terms. The United States may never announce that it wants a weaker dollar. It does not need to. If debt is high, deficits are large, and the central bank becomes more tolerant of inflation, the result can be the same. The dollar can lose value through inflation, through lower real yields, or through a gradual decline against other stores of value. Policymakers can still say they support a strong dollar. Markets will look at the incentives and decide what those words are worth. The most important point is that Warsh's hawkish image may actually be what makes future cuts possible. If a known dove cuts rates, markets panic about inflation credibility. If a perceived hawk cuts rates, markets are more willing to believe the cut is justified. That is the political magic of hawkish branding. It gives a central banker permission to ease without looking reckless. Nixon needed Volcker to break inflation. A different kind of president may need a hawk-looking Fed chair to make rate cuts look respectable. So when people say Warsh means higher rates and a stronger dollar, I think they may be stopping at the surface. Warsh may talk tough because he has to. He may simplify Fed communication because he wants authority. He may emphasize inflation because he needs credibility. But if his preferred inflation gauge tells him underlying inflation is cooling, then his own framework gives him a way to cut. That is the hidden dollar risk. The dollar is not threatened because one man likes trimmed inflation. It is threatened because trimmed inflation can become the official excuse for easier policy in a country that already needs easier financing conditions. It is threatened because the U.S. fiscal position makes high real rates painful. It is threatened because foreign capital is still needed, and foreign capital is not blind. It is threatened because reserve dominance is powerful, but it is not a blank check. In the short term, the dollar can rally. If markets believe Warsh is serious about inflation, yields can rise, and the dollar can strengthen. If oil spikes or geopolitical fear returns, the dollar can catch a safe haven bid. If Europe or China disappoints, the dollar can win by default. None of that breaks the long-term argument. A currency can rally cyclically and still weaken structurally. Traders care about the next data print. Long-term investors care about the policy regime. The policy regime is what matters here. If the Fed's new preferred lens says inflation is less dangerous, if the government's debt load says high rates are unaffordable, and if the political system wants growth more than restraint, then the dollar's long-term direction becomes easier to understand. It may not be a straight line. It rarely is. But the bias is toward depreciation, especially in real terms. That is why I would not look at Warsh and automatically say, hawkish Fed, stronger dollar. I would ask a different question. What number does he need to believe before he cuts? If the answer is trimmed inflation, and trimmed inflation is already much closer to target than headline or core inflation, then the market's hawkish interpretation may be too shallow. The Fed does not need to say the dollar should fall. It only needs to cut into sticky inflation while deficits remain large. The rest will be handled by real yields, foreign capital, and time.